Hello, everyone. I'm Howard Marks, co-chairman and co-founder of Oaktree Capital Management, a leading global alternative asset management firm founded in 1995. It's my pleasure to participate in the CNA Finance 2022 ESG Global Leaders Summit and to speak along with my esteemed peers about the role of sustainable investing and how Oaktree is playing its part. The growing demand for sustainable investing is driven by fundamental structural shift. More and more of our clients expect their investments to have a positive impact on the world. This raises an important question. What does responsible investing actually mean? The term itself is quite vague. Typically, responsible investing refers to a broad range of practices employed by asset managers. Some funds automatically exclude entire industries from their portfolios, while others strive to use qualitative and quantitative information on social, environmental, and governance matters as an important but not necessarily overriding component in their decision-making. Some investors exclude all companies in those industries from their holdings. Others will invest in companies they believe can be made to behave better. Clearly, this phrase, responsible investing, covers a lot of territory. The term is broad, in part because ESG-related practices are influenced by an asset manager's particular investment strategy, and strategies vary greatly between managers. For example, a fund that makes private control investments will likely be in a good position to make operational changes at its portfolio companies, including changes to ESG practices. This isn't typically the case for funds that make private non-control investments. The latter often have their greatest ability to have an impact before they invest their capital, when they can, for example, insist that debt contracts include ESG-related covenants or disclosure requirements. Asset managers' approaches to responsible investing will also be affected by the types of companies they target. Consider the difference between public and private companies. Public companies typically disclose more ESG data than private firms, but investors in public companies often don't have the ability to request customized reporting on ESG metrics. And because the rules regarding ESG disclosure are currently limited, companies may choose to report only data that makes them look good. Investors in private companies, on the other hand, may have a greater ability to request specific ESG data and limit companies' ability to cherry pick that data. But if they're smaller, private companies may be less well equipped to collect ESG-related data in the first place. Because there can't be a single definition of responsible investing that applies to every alternative investment manager, I think it may be useful for me to focus on how Oaktree approaches responsible investing. At Oaktree, we believe as long-term fundamental investors that integrating sustainability into our investment processes helps us identify and manage risks and opportunities. The term ESG may be relatively new, but many of the core ideas behind it are embedded in Oaktree's mission statement to deliver superior investment results with risk under control while conducting business with the highest integrity. In February of this year, we expanded our business principles for only the second time since our funding 27 years ago to include a principle concerning responsibility. We did so to ensure that we are clear about where Oaktree stands on questions of corporate social responsibility. When I attended business school at the University of Chicago in the 1960s, Milton Friedman was highly influential, both at the university and in the field of economics in general. Under his free market approach, a firm's contribution to society was measured entirely by its profits, the value it added between the cost of the inputs it consumed and the price it received for the goods it sold. In the late 1990s and early 2000s, the view reached its apex that the only job of the corporation was to make money for its shareholders. Today, many people, including corporate executives, accept that they have a greater responsibility to the planet we inhabit and the other people who live here. Many accept that business has to play an important role if the deterioration of the environment is to be arrested and if opportunities for employment are to be made and distributed equitably. Oaktree joins in accepting these responsibilities, and we reflect them in our business practices and our management of investments on behalf of our clients. Oaktree first codified its approach to responsible investments in 2014 when we drafted our socially responsible investment policy. In 2019, we signed on to the UN Principles of Responsible Investing, revise our ESG policy to align with PRI best practices, and put additional governance practices in place. We created an ESG governance committee comprised mostly of investment professionals to formalize, advance, and integrate ESG into our investment processes. We have processes in place to ensure that our investing groups incorporate ESG considerations when conducting due diligence before an investment is made and throughout the investment life cycle. Additionally, we frequently encourage portfolio companies to improve their ESG practices over time, particularly when such practices can have a positive impact on the company's value. These actions help us ensure that we're well aligned with the wishes of our clients and their beneficiaries. Our ESG practices are not exclusionary in nature. Our actions include contributing to the health of the climate by allocating capital to, for example, carbon-intensive industries and companies and making them better. We actively look for companies that show improving climate metrics and are spending money to reduce carbon emission. Specifically in China, we are investing in companies that are aligned with and poised to benefit from China's green energy transformation. For example, we're invested in a publicly listed Chinese company in the aluminum industry that is ahead of the curve in terms of its energy and greenhouse gas reduction plan. Between 2018 and 2021, this company has managed to achieve a 14% reduction in its carbon emissions. As the world emerges from the pandemic, we think investment opportunities connected to sustainability could potentially be significant sources of profit. This is especially true for those related to the green energy transition, as a massive gap exists between the investment the world needs and the funds committed so far. There are currently compelling opportunities in areas such as solar power, battery storage, the electrical grid, wind farms, and natural gas, to name just a few. At this challenging moment, when the investment climate is highly uncertain, some people may consider focusing on ESG factors to be an unaffordable luxury, but we disagree. It's true that companies that prioritize ESG concerns may incur additional costs in the short run, since focusing on sustainability is not always the cheapest way forward. Thus, some companies will experience lower profits because of the cost of ESG improvements. Others will profit from the expenditures that companies and society in general make to produce improvement, however. And in total, we think investment in sustainability will add to the strength of the economic recovery by being a component as GDP. We also think ignoring these concerns could prove costly over the long run for the companies themselves and for society at large. In particular, when we consider climate change, action is an absolute necessity, and the sooner we start, the better. We believe ESG-focused investment practices can make a major contribution to our ability to control risk, especially for long-term investors. We're aware of the impact that we and the financial industry as a whole have on the lives and livelihoods of people around the globe. At its best, our industry enables institutions and individuals to meet their financial goals, helps companies access capital, and promotes economic growth and innovation. We believe our industry's influence comes with significant responsibilities. This is one of the reasons why we've always stressed the importance of abiding by the highest ethical standards in every aspect of our business. In China, I know addressing climate change is of great importance. The company's 2060 carbon neutral goal, announced by President Xi Jinping in September 2020, advances China's low carbon policy support pursuant to the Paris Agreement, China's 2060 carbon neutral goal, and its aim to have CO2 emissions peak before 2030, will intensify the focus on climate-related corporate reporting and transformation, not only from companies, but also from the asset management firms that invest in those companies. In fact, we're already seeing a shift among the top pension funds and sovereign wealth funds in China as they start to incorporate ESG considerations into their investment processes. At Oaktree, we seek to be above average in every regard, which means we're always looking for ways to improve. In keeping with this philosophy, we'll continuously adjust how we integrate sustainability considerations in diligence, decision-making, monitoring, and engagement with portfolio companies. While our practices may evolve, our commitment to this work, which is rooted in our core principles, will remain unchanged. We at Oaktree look forward to playing a role in China's green energy transformation by continuing to invest in companies that are aligned with the country's 2060 carbon neutral goal, as well as by managing our clients' capital in a socially sustainable manner. I thank you all